Are you still putting money in a 401k and hoping for the best? Stop. Right now. The World Economic Forum's latest report shows 62% of experts predict economic turbulence over the next decade that will devastate traditional retirement accounts. I'm about to show you why your current financial strategy is like bringing a knife to a gunfight. By the end of this video, you'll understand the 5 shocking signs you're financially obsolete and the new blueprint smart money is following in 2025. The economic warning signs everyone's ignoring. Did you know the global economy is about to hit its biggest reset since 2008? Most people have no idea what's coming. While mainstream financial news celebrates stock market highs and talks about soft landings, behind closed doors, economic experts are having very different conversations. According to the latest World Economic Forum data, we're standing at the edge of a financial cliff that makes 2008 look like a minor stumble. What's truly alarming is that 52% of leading economic experts are now expecting significant economic instability within the next 2 years. Not a correction, not a hiccup, real lasting instability that could fundamentally reshape how wealth works. But turn on CNBC or Bloomberg and you'll hear a completely different story. The disconnect between what financial media is reporting and what economic insiders are preparing for has never been wider. While TV pundits debate whether inflation is cooling by 0.1%, investment banks are quietly repositioning billions to protect against what they see coming. This isn't just another market cycle. We're experiencing a fundamental shift in how wealth is created and preserved. The rules that built the middle class for the last 50 years are being rewritten before our eyes. Traditional wealth vehicles that performed reliably for decades are now flashing warning signs that most financial advisors aren't equipped to recognize. Take the housing market, for instance. The time-tested strategy of buying property as a safe investment is facing unprecedented pressures from rising interest rates, changing demographics, and remote work migrations. Markets that were considered always safe are experiencing volatility that historical models can't explain. Or look at corporate bonds, once the bedrock of conservative investment portfolios. With debt levels at historic highs and interest rates climbing, companies that appeared rock solid on paper are now facing liquidity challenges that weren't factored into traditional risk assessments. Even more concerning is the growing disconnect between economic indicators and real-world financial struggles. Unemployment figures look healthy on paper, but they mask the reality of underemployment, gig work without benefits, and jobs that no longer support a middle-class lifestyle. GDP growth numbers hide the fact that most of that growth is flowing to a smaller percentage of the population than ever before. The wealth gap isn't just a political talking point. It's the canary in the economic coal mine. When wealth concentration reaches certain thresholds, consumer spending, which drives roughly 70% of the U.S. economy, becomes increasingly vulnerable to shocks. We're now well past those thresholds. Meanwhile, AI and automation are accelerating at a pace that's reshaping entire industries in months rather than decades. Jobs that were considered secure career paths just 5 years ago are being transformed or eliminated entirely. The skills gap is widening faster than educational systems can adapt. Here's what makes this moment so critical. The financial strategies that worked during the last economic era aren't just becoming less effective, they're actively becoming liabilities. The conventional wisdom passed down from previous generations about saving, investing, and career planning is not just outdated. It's dangerous in today's economic reality. Over the next few minutes, I'm going to reveal 5 shocking signs that your current money strategy might be completely obsolete in this new economy. These aren't minor tweaks or optimizations. They're fundamental blind spots that could determine whether you thrive or struggle in the economic landscape of 2025 and beyond. These 5 indicators of financial obsolescence aren't theoretical problems for some distant future. They're already impacting your wealth-building potential right now, often in ways that traditional financial metrics don't capture. Understanding these shifts isn't optional if you want to preserve, let alone grow, your wealth in the coming years. Why your 401k strategy is becoming financial suicide. While understanding changing economic realities is crucial, there's something sitting in your financial portfolio that may be quietly betraying you. The 401k plan, once considered the bedrock of American retirement planning, is showing dangerous cracks that most financial advisors won't openly discuss. What if that retirement account you faithfully contributed to for years is actually setting you up for financial disappointment rather than security? For our parents' generation, the 401k was revolutionary. Introduced in the early 1980s, it shifted retirement responsibility from employers to employees while offering compelling tax advantages and employer matching. During decades of relative economic stability, consistent market growth, and manageable inflation, these accounts served many Americans well. But the math behind traditional 401ks has changed dramatically, and not in your favor. Over the past 3 to 5 years, these accounts have been struggling to keep pace with inflation, leaving many savers running in place or even losing ground. While inflation is expected to stabilize around 3.5% in 2024, the real returns on many 401k accounts have been negative due to higher inflation rates in previous years, effectively eroding your purchasing power despite growing account balances. Even more concerning is what's happening behind the scenes with fees. Most people have no idea how much their 401k is actually costing them. Those seemingly small percentages listed in the fine print? They're silently devouring your retirement dreams. Studies show that high fees can reduce your retirement savings by as much as 30% over a 30-year period. That's not a typo. Nearly a third of your retirement could be going to financial institutions instead of funding your future. Let me put this in perspective. Say you're diligently saving $500 monthly in your 401k with an average annual return of 7%. With low fees of 0.5%, you'd have about $566,000 after 30 years. But with fees of 2%, common in many plans, you'd end up with just $398,000. That's $168,000 less for your retirement. And most people never even notice this massive wealth transfer. The problem gets worse when we examine another dangerous assumption baked into traditional retirement planning: that historical market returns will continue indefinitely. Financial advisors love showing charts of the stock market's upward trajectory over the past century, but economic conditions have fundamentally changed, from record government debt to unprecedented technological disruption and shifting global power dynamics. The market vulnerability of these accounts was starkly demonstrated during recent global economic shocks. During the COVID-19 pandemic, for instance, the S&P 500 dropped by over 30%, causing millions of Americans to see their 401k balances plummet almost overnight. While markets eventually recovered, these dramatic swings revealed how exposed traditional retirement accounts are to sudden economic turbulence, the kind that's becoming increasingly common in our interconnected global economy. Financial experts are increasingly raising red flags about the future viability of traditional retirement vehicles in light of economic instability and changing market conditions. Many analysts now recommend diversifying retirement savings beyond the conventional 401k approach, suggesting that reliance on these accounts alone represents a significant risk, rather than the safe harbor many believe them to be. What's truly alarming is how retirement account underperformance compounds over time. A few percentage points below inflation might not seem dramatic in a single year, but over decades, it can mean the difference between a comfortable retirement and working well into your 70s or even 80s. The traditional retirement vehicles aren't failing because they've changed. They're failing because the economic landscape around them has transformed while they've remained static. This growing vulnerability isn't theoretical. It's affecting millions of Americans right now who believe they're on track for retirement but are actually falling further behind each year. And that's why traditional investment vehicles, particularly 401ks, are now considered high-risk propositions in the 2025 economy. Sign number 1. You're still relying on a single income stream. As concerning as retirement vulnerability may be, there's an even more urgent financial weakness that could impact you decades before you even reach retirement age. In an economy where a single job loss can trigger complete financial collapse, having just one income stream isn't just risky, it's becoming financially suicidal. The days when a single steady paycheck could comfortably support a household are quickly becoming ancient history. Think about it. Your grandparents likely built their entire financial lives around one reliable income that grew steadily year after year. Companies rewarded loyalty with consistent raises, promotions, and the golden promise of a pension. Job security wasn't just a perk, it was the expected norm. But that economic reality has completely vanished. Looking at the numbers tells a shocking story of stagnation. Young men without a college degree have watched their earnings decline steadily since 1973, with only modest increases in recent years. In 2023, those without a high school diploma earned just $30,700 annually, while high school graduates reached about $45,000, still below what similarly educated workers made 5 decades ago. This income stagnation wouldn't be nearly as devastating if the cost of living had remained stable. But we've seen exactly the opposite. Housing, healthcare, education, and even basic necessities have skyrocketed, creating a financial squeeze that's crushing the single-income household. The math is brutally simple. When 76% of young adults cite rising living costs as their primary financial concern, while wages barely budge, the traditional one-job model becomes completely unsustainable. This creates what financial experts call income fragility, a state where your entire financial foundation can crumble with a single setback. Imagine what happens when that one precious paycheck suddenly disappears. Without backup income sources, you're instantly in survival mode, raiding retirement accounts, maxing out credit cards, or liquidating assets at the worst possible time. One health crisis, company downsizing, or industry disruption can wipe out years of careful saving in a matter of months. What's fascinating is how differently financially secure individuals approach this problem. Among those who've maintained or improved their standard of living, income diversification isn't just a nice bonus. It's a deliberate strategy. Case studies show that many of these individuals have systematically built side hustles that complement their primary income. And this isn't just a temporary trend. 65% of younger generations plan to start or continue side hustles in 2025, with 41% considering these additional income streams their primary financial goal. But here's where things get really interesting. The wealthiest individuals don't just create multiple income streams, they master something called income leverage. This is fundamentally different from simply working more hours across multiple jobs. Income leverage means finding ways to multiply your earnings without a proportional increase in effort. Consider someone who develops expertise in content creation. Instead of trading hours for dollars in a traditional job, they might create digital products that generate revenue while they sleep. Or look at e-commerce entrepreneurs who build systems that scale their sales without requiring their constant attention. These aren't theoretical examples. They're proven paths to income multiplication that anyone can learn. What's particularly exciting about 2025 is how AI tools are democratizing income leverage strategies. We're seeing a surge in AI-powered side hustles where individuals use sophisticated technology to enhance their productivity and take on more clients without proportionally increasing their effort. Someone who previously could manage 3 to 4 freelance clients might now handle 8 to 10 with the same hours invested, effectively doubling their income without sacrificing their lifestyle. The good news? Creating these multiple income streams doesn't require quitting your job or working 80-hour weeks. There's a methodical approach to income diversification that starts small, leverages your existing skills, and gradually builds additional revenue pipelines that protect you from economic uncertainty. Sign number 2. Your investment strategy ignores AI and automation. That methodical approach to income diversification is only half the equation in today's rapidly evolving economy. While building multiple income streams protects you from paycheck vulnerability, your investments might be facing an entirely different threat. Have you checked if your portfolio is positioned for the AI revolution? Because if not, you might be watching from the sidelines as one of the greatest wealth transfers in modern history unfolds right before your eyes. The investment landscape isn't just changing, it's being completely rewritten by artificial intelligence. This isn't simply another tech trend or market bubble. We're witnessing a fundamental reshaping of entire industries that's creating clear economic winners and losers at a pace we've never seen before. Look at what's happening in healthcare, finance, and retail. Companies leveraging AI for medical diagnostics are reducing error rates while cutting costs by up to 30%. Financial institutions using algorithmic trading are capturing market opportunities in milliseconds that human traders could never access. And retailers implementing AI-powered inventory management are slashing waste while boosting profits. But here's the shocking reality. Over the past 24 months, there's been a massive performance gap between AI-focused investments and traditional market sectors. While some traditional retail and manufacturing stocks have struggled to maintain relevance, companies at the forefront of automation have seen their valuations soar. This isn't just market volatility. It's a systematic redistribution of market value toward businesses that harness these technologies effectively. The automotive industry provides a perfect example of this divide. Traditional manufacturers clinging to conventional production methods are watching their market share erode, while companies embedding AI into both their vehicles and manufacturing processes are experiencing dramatic productivity gains. The difference isn't subtle. It's defining which businesses will exist a decade from now. What's even more fascinating is that AI isn't just improving existing industries. It's creating entirely new investment categories that simply didn't exist 3 years ago. AI-driven healthcare solutions that can predict patient outcomes before symptoms appear. Automated trading platforms that democratize sophisticated investment strategies previously available only to hedge funds. These innovations aren't just attracting venture capital, they're becoming entirely new pillars of the investment landscape. Yet most traditional financial advisors are completely behind the curve on understanding these technological shifts. They're still recommending the same balanced portfolio of established companies that worked in the pre-AI economy. The problem? Those recommendations are increasingly based on outdated models that don't account for how rapidly technology is restructuring economic value. The research is clear. Wealth is increasingly concentrating in companies that effectively leverage AI technologies. This isn't just creating market winners and losers, it's potentially widening the gap between investors who recognize this shift and those who don't. Financial experts predict that this technological divide will reshape wealth distribution throughout the entire economy over the next decade. But here's the good news. You don't need to be a tech expert to position yourself on the right side of this divide. Today's investment platforms are making it easier than ever for everyday investors to gain exposure to AI-focused companies and sectors. There are now specialized ETFs that track companies leading in automation, machine learning, and algorithmic innovation. AI-powered investment apps can help you identify opportunities in this space without requiring a computer science degree. And the most exciting development? The emergence of AI-powered trading platforms is democratizing access to sophisticated investment strategies, allowing regular investors to utilize algorithms that analyze market trends and execute trades automatically. This means you can benefit from the same technological edge that was previously reserved for institutional investors with deep pockets. Sign number 3, you're paying 2023 taxes in a 2025 economy. While technology is leveling the investment playing field, there's another wealth gap hiding in plain sight that costs the average person over $5,000 every single year. The ultra-wealthy aren't just making more money, they're keeping dramatically more of what they earn through tax strategies most Americans have never even heard of. The tax landscape has undergone a dramatic transformation thanks to the digital economy, remote work policies, and shifting global tax regulations. Yet, most people are still filing taxes like it's 2015, completely missing the opportunities this new landscape presents. What's shocking is how many digital entrepreneurs don't realize they're caught in what experts call the nomad trap. Many remote workers and digital nomads incorrectly assume that simply leaving their home country exempts them from tax obligations. This misconception can lead to serious penalties and fines when tax authorities catch up, and they always do. For U.S. citizens looking to legally minimize their tax burden, there's a strategic approach many aren't aware of. To become a tax non-resident, you'll need to spend at least 330 days in foreign countries within a 365-day period. This isn't just about traveling. It requires careful planning and proper business structuring to avoid taxes on worldwide income. One of the most powerful strategies being leveraged by savvy entrepreneurs is earning money through offshore companies. When structured correctly, this approach allows individuals to avoid personal taxation on income earned abroad. It's completely legal, but it requires understanding territorial taxation systems. Countries like Malaysia, Singapore, and Panama practice what's called territorial taxation, meaning they only tax income earned within their borders. This creates incredible opportunities for digital business owners who can strategically position their income sources. For business owners staying domestic, there are still powerful strategies being left on the table. The 100% bonus depreciation for business assets allows you to deduct the entire cost of eligible assets in the same year they're purchased. This can dramatically reduce your taxable income while preserving cash flow for your small business. Startup founders should be paying attention to the increased deduction limit on startup costs, which has jumped from $5,000 to $50,000. This adjustment makes it possible to manage initial expenses, like legal fees and marketing costs, much more effectively, keeping more money in your business when you need it most. Many entrepreneurs are unknowingly overpaying thousands in taxes simply by missing deductions they qualify for. The home office deduction remains one of the most underutilized tax benefits, along with business expenses paid from personal accounts. These overlooked deductions add up to significant overpayments year after year. Tax credits offer an even more powerful opportunity than deductions, reducing your tax liability dollar for dollar. The Research and Development Tax Credit and the Work Opportunity Tax Credit are just two examples that could save your business substantial amounts. Yet most small business owners have never even applied for them. What's truly mind-blowing is that implementing just one new tax strategy could save you thousands annually. Most people are completely unaware of these optimization opportunities that have emerged in our evolving economic landscape. This isn't about complicated tax evasion schemes. It's about understanding the legitimate options available in a digital economy that most tax professionals aren't proactively sharing with their clients. The wealthy aren't doing anything illegal. They're simply staying informed about how the tax code applies to new economic realities. The good news? You don't need to be ultra-wealthy to benefit from these strategies. With the right information and planning, these same tax optimization approaches can be accessible to anyone willing to learn the new rules of the digital economy. The question isn't whether you can afford to implement these. Sign number 4, your debt strategy is stuck in the low-interest era. Just as tax strategies have evolved with the digital economy, your approach to debt must transform as well. Credit card interest rates have skyrocketed past 20% in 2025, turning what used to be manageable debt into a wealth-draining nightmare. The financial strategies that worked during the decade of cheap money are now silently sabotaging your financial future. Remember when carrying a credit card balance or taking out a variable rate loan wasn't a big deal? For nearly a decade, we lived in an economic fantasy land where money was practically free. Banks were handing out loans with rock-bottom rates, and millions of Americans structured their entire financial lives around these cheap borrowing costs. That era is officially over, and if you haven't adjusted your approach to debt, you're hemorrhaging money. The impact of rising interest rates has hit variable rate debt the hardest. Those convenient credit cards and personal loans that were once reasonable financial tools have transformed into wealth destroyers. Many borrowers are now facing monthly payments significantly higher than just a few years ago, leading to a concerning increase in defaults across the country. What's even more alarming is how outdated debt strategies are affecting everyday Americans. Take the common advice to only make minimum payments on low-interest debt, while focusing on high-interest debt. That made perfect sense when, Low interest actually meant low interest. Today, what was once considered a manageable 8% loan might now be charging 15% or more, completely undermining your financial progress. But here's where things get interesting. While most people are struggling with these changes, the financially savvy are implementing what experts call strategic debt transformation. This isn't just about paying off debt faster, it's about completely restructuring your debt profile to align with today's economic reality. The wealthy aren't simply trying to eliminate debt, they're strategically transforming it. They're refinancing high-interest debt into lower-interest loans and consolidating multiple debts into single loans with better terms. This approach optimizes their debt management while freeing up cash flow for investments. Even more fascinating is how the wealthy are using debt as a wealth-building tool rather than treating it as a necessary evil. Instead of taking on debt for consumption, they're leveraging low-interest loans for investments. They're using home equity lines of credit to finance rental properties and other ventures that generate returns higher than the cost of borrowing. For example, many homeowners in 2025 are refinancing their mortgages to take advantage of rate drops, creating additional cash flow that can be redirected into investments or savings. This strategy not only reduces monthly payments, but enhances their overall financial position. The key difference is viewing certain types of debt as potential assets when managed strategically. This requires a fundamental mindset shift, from seeing debt as purely a burden to recognizing it as a potential wealth-building tool when used correctly. Financial advisors are increasingly advocating for this perspective shift, emphasizing that the right kind of debt, structured properly, can accelerate wealth creation rather than hinder it. Different types of debt are being impacted differently by today's economic conditions. While credit card and personal loan rates have surged dramatically, other lending categories present strategic opportunities. Understanding these nuances is crucial for developing an effective debt strategy in 2025's economy. The good news? You don't need to be ultra-wealthy to implement these debt transformation strategies. With proper planning and knowledge, you can restructure your debt in ways that align with today's economic reality. The question isn't whether you should transform your debt strategy, it's whether you can afford not to. Sign number 5, you're ignoring the financial wellness revolution. Beyond transforming your debt, there's a silent revolution happening that's reshaping how an entire generation views money. It's not about bigger portfolios or fancier investment strategies. It's about completely reimagining what financial success actually means. Young adults aren't just tweaking the old wealth-building playbook. They're writing an entirely new one centered on financial wellness. This isn't some passing trend. According to recent research, 44% of young adults report significant improvements in their quality of life since embracing financial wellness principles. That's nearly half of an entire generation discovering that their relationship with money matters just as much as the amount they have. So what exactly is this financial wellness revolution? At its core, it's about taking a holistic approach to wealth that aligns with your personal values and contributes to long-term life satisfaction. Unlike traditional financial advice that focuses almost exclusively on accumulation, bigger numbers, more assets, higher returns, financial wellness asks a fundamentally different question. What's money actually for? This shift might sound philosophical, but it's producing measurable results. Financial wellness practitioners are building much more resilient positions during economic uncertainty. When market volatility strikes or unexpected expenses pop up, those embracing these principles aren't derailed from their long-term goals. They've built financial safety nets that traditional wealth strategies often overlook. What's particularly interesting is how psychological principles form the foundation of financial wellness. Traditional financial planning tends to treat money as purely mathematical, plug the numbers into the right formulas, and outcome success. But financial wellness recognizes that our mindset around money dramatically impacts our decisions and outcomes. For example, viewing money as a tool for growth rather than just income transforms how you approach financial decisions. It's no longer about restriction, I can't afford that, but about alignment. Does this expense move me toward my goals? This subtle shift creates a positive relationship with finances rather than the anxiety-inducing approach that leaves many people feeling constantly behind. And here's where things get really interesting. These aren't separate paths. The integration of financial wellness principles with traditional wealth-building strategies creates superior results compared to either approach alone. When you align your financial practices with your personal values and life goals, you make better decisions that ultimately benefit your bottom line too. This holistic approach creates a fascinating paradox. By focusing less obsessively on the numbers, people often end up with better financial outcomes. By building emergency funds, practicing intentional spending, and cultivating financial mindfulness, individuals create the stability needed to make bolder wealth-building moves when opportunities arise. Financial experts are increasingly acknowledging that building wealth isn't just about clever investment strategies or tax hacks. It's equally about cultivating a mindset that embraces abundance and proactive financial management. When you combine practical strategies with psychological wealth principles, you create a powerful foundation that can weather any economic storm. The old model of chasing the biggest possible nest egg while sacrificing present well-being is becoming obsolete. Today's financially savvy individuals are finding balance between securing their future and living well now. They're setting clear boundaries around work and money, creating sustainable financial practices that don't lead to burnout, and defining success on their own terms. What separates financially secure people from anxious ones often isn't the balance in their bank accounts, it's their psychological relationship with money. Two people with identical net worths can have dramatically different experiences based on how they think about and manage their resources. The financially secure person feels abundant even while building wealth, while the anxious person feels scarce even with substantial assets. The new blueprint, AI-powered side hustles that actually work. That psychological relationship with money becomes even more powerful when paired with today's AI revolution. The tools once reserved for tech giants generating billions in revenue are now available to anyone with a smartphone and internet connection. Ever wondered why some side hustlers make 5 figures monthly, while others struggle to break even with the same time investment? The difference often isn't hustle, it's leverage. Let's be real. Traditional side hustles can be exhausting. Whether it's driving for Uber, freelance writing, or selling handcrafted items on Etsy, the income-to-effort ratio often leaves much to be desired. You trade hours for dollars, hit income ceilings quickly, and find yourself working nights and weekends just to make modest gains. AI-powered side hustles flip this equation on its head. Instead of trading time for money in a linear relationship, these opportunities allow you to set up systems that generate income with minimal ongoing maintenance. Think of it as building income machines rather than continuously turning the crank yourself. Take content creation, for example. Tools like Jasper and Copy.ai are revolutionizing how freelancers work. What once took 8 hours to create, blog posts, marketing materials, social media content, can now be generated in under an hour with the right AI prompts. This isn't about replacing creativity, but amplifying it. Freelancers who've embraced these tools report handling triple their previous client load without increasing work hours. Customer service, traditionally a time-intensive field, has been transformed by AI chatbots. Using platforms like Chatfuel or Dialogflow, tech-savvy individuals are building and selling automated customer service solutions to small businesses. These systems handle routine inquiries 24/7, reducing operational costs while generating subscription revenue for the creator. The setup takes effort, but once established, these systems run with minimal oversight. The creative industries haven't been left behind. AI-generated art through tools like DALL-E and Midjourney has opened doors for people who couldn't previously participate in the visual arts market. Users are creating unique designs, illustrations, and artwork that sell on platforms like Etsy and Society6, turning simple text prompts into profitable digital products. Video content creators are leveraging tools like Faceless.video to produce engaging YouTube content without ever appearing on camera. These platforms automate much of the video production process, allowing creators to focus on research and scripting, while the AI handles animation, voiceovers, and editing. Many of these channels generate substantial ad revenue on autopilot after the initial setup. Even in financial markets, AI is changing the game. Automated trading tools analyze market patterns faster than humanly possible, executing strategies day and night without emotional interference. While this requires more initial capital and learning, the return on effort can be substantial compared to traditional investing approaches. What makes these AI side hustles truly revolutionary is how they remove traditional barriers to entry. You don't need a computer science degree to use these tools effectively. Most platforms feature intuitive interfaces designed for beginners, with templates and guides to help you get started. The learning curve is surprisingly manageable, especially compared to the skills typically required for high-paying opportunities. Take Eileen Kang's story. A jewelry designer by passion but not by training, she struggled to scale her small Etsy shop beyond a few sales per month. After incorporating AI tools for product photography enhancement, marketing copy, and customer service automation, her monthly income jumped from $400 to over $3,000, while actually reducing her daily time investment from 4 hours to less than 2. If you're considering exploring these opportunities, start by assessing your personal strengths and interests. The most successful AI side hustlers don't chase random opportunities. They align AI tools with their existing knowledge or passions. Next, identify specific market needs where automation could add value. Finally, focus on leveraging AI to enhance your productivity rather than replacing your unique contributions entirely. The new blueprint: revolutionary investment platforms. The tools you use for investing aren't just minor details. They're literally reshaping who wins and who loses in today's economy. While you're logging into the same clunky investment dashboard that hasn't changed since 2010, financially savvy investors are accessing opportunities you don't even know exist. Let's be real. Traditional brokerages were built for a world where information moved slowly, where only professionals had access to real-time data, and where you needed $100,000 minimums to access the best investments. That world is gone, but most people's investment platforms haven't caught up. These next-gen investment platforms aren't just prettier versions of the same old thing. They're fundamentally different in how they approach wealth building. Think about it. When was the last time your current investment platform recommended adjustments before market shifts happened instead of after? Or customized your portfolio based on your unique financial situation instead of generic risk categories? The difference shows up in performance. Users of these new investment platforms are consistently achieving better outcomes compared to people stuck with legacy systems. It's not because they're smarter investors, it's because their platforms are giving them tools that traditional brokerages simply don't offer. What makes these new platforms revolutionary? For starters, they're leveraging AI-driven insights and real-time data analytics to provide truly personalized wealth strategies. Instead of generic, moderate growth portfolios, these platforms analyze hundreds of data points to create investment approaches uniquely tailored to your situation. Remember how investing in commercial real estate or private equity was something only millionaires could do? That barrier is crumbling thanks to fractional ownership models. Now you can own portions of high-value assets with as little as $100 in some cases. This democratization means you can diversify across asset classes that were previously off-limits unless you had serious wealth. Tokenization is another game changer that's transforming investment accessibility. By dividing assets into smaller, tradable digital units, these platforms are broadening the market for everything from real estate to collectibles. Instead of needing $500,000 to invest in a profitable apartment building, you can own a small piece and still get proportional returns. Direct index investing is replacing traditional ETFs and mutual funds on these platforms too. Unlike funds that force you to own hundreds of companies you might not want, direct indexing lets you customize exactly what you own, optimize for tax efficiency, and align investments with your values. The tax savings alone from these strategies can add 1 to 2% to your annual returns. The user experience on these platforms is designed for today's investors, not your parents. They feature mobile-first interfaces and even gamification elements that appeal to younger investors who want engagement, not just quarterly statements in the mail. This isn't just about looking pretty. It's about making investing accessible and interesting enough that people actually stay engaged with their financial future. Many of these platforms are also pioneering hybrid advisory models, combining automated investing with human oversight. This gives you the efficiency of algorithmic management with the personalized guidance of a human advisor when you need it. The result is customized advice at a fraction of traditional management fees. The platforms also provide real-time customized recommendations that enhance user engagement and satisfaction. Instead of cookie-cutter advice, you get insights specifically relevant to your financial situation and goals. This level of personalization was previously available only to the ultra-wealthy with private wealth managers. What's especially exciting is how these platforms are responding to the demand for financial flexibility among younger generations. They're developing tools that allow for easy transitions between various investment strategies as your life situation changes, something traditional brokerages make needlessly complicated. By 2027, AI-driven investment platforms are predicted to manage over $2 trillion in assets. That's not just a trend, it's a fundamental shift in how wealth is built and managed. If your money isn't benefiting from these technological advances, you're essentially choosing to use outdated tools in a competition where everyone else has upgraded. The new blueprint: strategic asset allocation for turbulent times. Those trillion-dollar platforms are impressive, but they're still just tools. And even the best tools can't fix a fundamentally broken strategy. The classic 60-40 portfolio that financial advisors have recommended since your parents' time has been quietly failing in the background during every recent market crisis. While technology is evolving rapidly, the actual blueprint for what you own needs a complete redesign. Let's be honest about what's happening. Traditional asset allocation models are crumbling under the weight of our current economic reality. The 60-40 portfolio, that perfect balance of stocks and bonds that was supposed to protect you in any market, is becoming increasingly ineffective. Why? Because the fundamental relationship between these asset classes has changed. When markets crashed in 2022, both stocks and bonds plummeted simultaneously, leaving investors with nowhere to hide. This isn't just a temporary glitch. It's a structural shift in how markets function in our new economic reality. The diversification that was supposed to protect you is now leaving you exposed. So what's working instead? Forward-thinking financial advisors are completely reimagining asset allocation frameworks. They're moving beyond the old stock and bond formula to incorporate truly uncorrelated assets, investments that don't move in lockstep with traditional markets when everything goes sideways. These new models distribute your money across a wider spectrum of investments, specifically designed to perform differently under various economic conditions. Property-backed investments through specialized vehicles like innovative finance ISAs are delivering target returns between 5.4% and 7% even during market turbulence. Infrastructure investments are becoming portfolio mainstays because they provide steady income streams regardless of market conditions. The most exciting shift is happening with direct index investing, a strategy that's growing 12% faster than ETFs. Unlike traditional funds that force you into preset allocations, direct indexing lets you own the individual securities that make up an index. This gives you unprecedented customization and tax advantages that can significantly boost your after-tax returns. What makes this approach so powerful? It's not just about owning different assets, it's about owning assets that respond differently to economic threats. When inflation spikes, certain commodities might soar. When interest rates climb, specific types of bonds can actually benefit. When markets panic, particular alternative investments tend to remain stable or even appreciate. The allocation percentages are shifting too. For conservative investors approaching retirement, financial advisors are now recommending higher allocations to fixed income alternatives and protective assets. If you're more aggressive with a longer time horizon, the new models suggest greater exposure to equities, complemented by strategic positions in real assets that can capture growth while buffering volatility. This isn't just theory, it's already working. Investors who've embraced these emerging allocation frameworks have experienced significantly less portfolio volatility during recent market disruptions while maintaining competitive returns. During the most recent correction, traditionally allocated portfolios saw drawdowns of 15 to 20%, while those using modern frameworks experienced half that volatility. The most compelling part? You don't need to be ultra-wealthy to implement these strategies. Many of these non-traditional assets are now accessible through specialized platforms that have dramatically lowered minimum investments. Assets that once required $250,000 to access are now available for $1,000 or less. Imagine being able to sleep through the next market crash because your portfolio was designed from the ground up to weather economic storms, not just ride out bull markets. That's the difference between old and new allocation models. Here's the reality check. Continuing with outdated asset allocation isn't just suboptimal, it's becoming financially dangerous. The economic environment we're navigating requires a fundamental rethinking of how we construct portfolios. Small adjustments to an outdated framework won't cut it anymore. The financially savvy are completely reimagining what it means to be diversified in 2025. The new blueprint, Geographic Arbitrage Strategies. Reimagining where you earn and spend money might be the most overlooked financial strategy of our time. While most Americans limit their financial lives to a 50-mile radius, a new breed of wealth builders is tapping into geographic arbitrage, strategically positioning themselves across borders to maximize their financial potential without necessarily relocating permanently. Let me break down what geographic arbitrage actually means. It's the practice of earning income in high-value currencies while spending in places where your money stretches significantly further. The beauty of this approach in 2025 is that you don't need to be a digital nomad with a laptop on a beach to benefit, although that's certainly one way to do it. The financial math is simply undeniable. Consider this. Earning a U.S. salary while spending in countries like Malaysia or Portugal can effectively boost your purchasing power by 40% or more overnight. That's like giving yourself an instant raise without asking your boss for a penny more. What makes today's economic landscape so perfect for geographic arbitrage is the global growth projections we're seeing. While developed economies are experiencing modest growth, developing regions like parts of Africa and Latin America are poised for acceleration. Spain, for example, is projected to grow at about 2.5% in 2025, driven by a resilient services sector and expanding manufacturing, creating attractive opportunities for both investment and income. The tax advantages alone can transform your financial picture. Countries like Malaysia, Singapore, and Panama operate on territorial taxation systems, meaning they only tax income earned within their borders. This creates incredible opportunities for remote workers and entrepreneurs to legally optimize their tax situations without complex structures. But perhaps the most exciting aspect is how accessible these strategies have become. The rise of remote work and digital business means you can implement geographic arbitrage without uprooting your entire life. You might maintain your primary residence in your home country while strategically spending time abroad, or structure your business to capture tax advantages across multiple jurisdictions. Let me share a real-world example. Michelle, a marketing consultant from Chicago, maintains her U.S. clients but spends 4 months each year living in Portugal. During those months, her daily expenses drop by nearly 60%. She experiences zero winter heating bills, and she accesses healthcare at a fraction of U.S. costs. The result? She saves an additional $25,000 annually while enjoying a higher quality of life. Or consider James, who established a small online business while maintaining his full-time job. By properly structuring his company through Singapore, he legally reduced his business tax rate from 35% to under 10% on his international earnings. He visits Singapore twice yearly, but runs operations remotely from his hometown. Countries like Portugal and Costa Rica have become hotspots for these strategies, offering exceptional quality of life with affordable healthcare, vibrant cultures, and welcoming communities. They're not just vacation destinations, They're financial strategy hacks. So how do you identify which geographic opportunities align with your situation? The framework begins with assessing 3 key factors: your income potential, lifestyle preferences, and remote work flexibility. Ask yourself, can you earn income remotely or from multiple locations? What quality of life factors matter most to you? And what tax implications might arise from different arrangements? Even implementing partial geographic arbitrage strategies can yield substantial benefits. You might maintain your current living situation, but establish a side business in a tax-favorable jurisdiction. Or perhaps, you could negotiate a remote work arrangement that allows for extended stays abroad during certain months of the year. The data is clear. Individuals leveraging global opportunities through geographic arbitrage consistently enhance their financial outcomes compared to those confined to local markets. They access better income potential, wealth mindset, lower living costs, and often improved quality of life. The inner game of wealth is the secret weapon most financial advice ignores completely. While we've explored powerful strategies from geographic arbitrage to investment platforms, there's a hidden force at work that determines whether you'll implement any of these approaches, and it lives entirely between your ears. Ever notice how some people with modest incomes consistently build wealth, while others making 6 figures live paycheck to paycheck? The difference isn't just knowledge, it's mindset. According to Ray Dalio, one of the world's most successful investors, building wealth requires something far more fundamental than market knowledge: the ability to delay immediate gratification. Think about the famous marshmallow test, where children who could resist eating 1 marshmallow to get 2 later showed better financial outcomes decades later. This simple experiment reveals a powerful truth about wealth building. It's not just what you know, but how your brain processes financial decisions that matters most. Let me introduce you to the concept of the wealth mindset reset. This isn't about positive thinking or manifesting money through wishful thinking. It's about rewiring your brain's relationship with money based on proven psychological principles. Wealthy individuals don't just know different information, they process financial information differently. While most people see money as something to spend or hoard, the financially successful view it as energy to direct toward opportunities. They make decisions based on potential return rather than immediate emotional payoff. This fundamental shift makes all the difference. When you're drowning in financial stress, your brain physically cannot access its creative problem-solving centers. It's too busy operating in survival mode. But when you shift to viewing money as a tool rather than a source of anxiety, you unlock neural pathways that lead to better financial decisions. One practical exercise for beginning this reset comes from author Jen Sincero. She recommends writing a love letter to money to uncover your emotional blocks around wealth. This might sound silly, but it's remarkably effective at revealing the unconscious beliefs holding back your financial growth. Do you secretly believe money is dirty? That wealthy people are greedy? That you don't deserve abundance? These hidden beliefs sabotage your efforts before you even begin. Another powerful practice is gratitude journaling. By writing down 5 things you're grateful for each morning, you shift your focus from lack to abundance. This isn't just feel-good advice, it's neurological training that helps your brain spot opportunities instead of obstacles. Consider Mark, a software developer who knew all the right investment strategies but couldn't seem to save more than a few $100s monthly. Through mindset work, he discovered a deep-seated belief that money always leaves. This belief stemmed from watching his parents struggle financially during his childhood. Once identified, he could challenge this belief and create new mental patterns. Within 6 months, his savings rate tripled, not because he earned more, but because he stopped unconsciously sabotaging his efforts. The most successful wealth builders understand that financial education alone isn't enough. As both Dalio and Sincero emphasize, acquiring knowledge must be paired with mentorship and personal development to create lasting change. The wealthy consistently invest in their own education, understanding that their earning potential is directly tied to their knowledge and skills. This wealth mindset reset involves 4 key principles. First, viewing money as a neutral tool rather than an emotional trigger. Second, developing comfort with delayed gratification. Third, maintaining a growth mindset about your financial abilities. And fourth, creating conscious awareness of your spending decisions rather than operating on autopilot. When applied consistently, these principles transform your relationship with money from one of stress to one of strategy. You'll find yourself naturally implementing the techniques we've discussed throughout this series because they'll align with your newly rewired brain. Track your spending meticulously and maintain a budget, not because some financial guru told you to, but because you genuinely value understanding where your energy, money, is flowing. Set regular check-ins to assess your financial goals and adapt your strategies accordingly. Implementation strategy, the 30-day financial reset. While tracking your spending is crucial, 76% of people abandon their budgets within the first month. The problem isn't you, it's that nobody showed you the right sequence to build financial habits that actually stick. Let me walk you through the exact 30-day reset that works even if every previous attempt has failed. Most people try changing everything about their finances at once. That's like trying to run a marathon without training. This 30-day reset breaks down what seems impossible into weekly chunks that your brain can actually process. The beauty is that each week builds on the previous one, creating momentum that carries you through the entire month. Let's start with week 1, creating a budget and tracking your spending. This is your financial foundation. Download tools like Mint or You Need a Budget YNAB to get a crystal clear picture of where your money's going. These apps do the heavy lifting by categorizing your expenses and showing you exactly where you can cut back. Spend just 15 minutes each day reviewing your transactions. This small habit creates massive awareness that most people never develop. Moving into week 2, it's time to build your emergency fund. The goal is to eventually have 3 to 6 months of expenses saved, but don't let that big number scare you. Start with just $500, enough to cover a minor emergency without reaching for a credit card. Apps like Digit and Qapital can automate this process by analyzing your spending patterns and quietly moving small amounts into savings without you feeling the pinch. One user shared, "I didn't even notice the money leaving my account, but after just 1 week I had saved $143. Week 3 focuses on debt management. Now that you understand your spending and have started your emergency fund, it's time to tackle what's holding you back. The Debt Payoff Planner app helps create a structured strategy for eliminating high-interest debt first. This approach typically saves people thousands in interest payments alone. Take all your debts, credit cards, personal loans, student loans, and prioritize them by interest rate. Then focus all your extra money on the highest rate debt while making minimum payments on everything else. By week 4, you're ready to start investing, even if it's just $10. Platforms like Robinhood and Acorns make it possible to begin with whatever you have. Acorns even rounds up your purchases to the nearest dollar and invests the spare change. This isn't about getting rich quick. It's about harnessing the power of compound interest as early as possible. Starting with just $10 weekly, growing at 7% annually, can turn into over $52,000 in 30 years. What makes this 30-day reset different from traditional financial advice is the sequence. Most people try starting with investing before they've addressed their spending or debt. That's like building a house starting with the roof. This reset works because each week creates the foundation for the next step. Sarah, a preschool teacher from Atlanta, completed this reset last year. I'd tried budgeting apps before, but always quit after a few days. This time was different because I wasn't trying to do everything at once. By the end of the month, I'd saved $600 for emergencies, created a plan to be debt-free in 18 months, and started investing $25 weekly. I finally feel in control. The tools matter too. Traditional budgeting methods required spreadsheets and hours of work. Today's apps do most of the heavy lifting, giving you insights instead of busy work. The key is choosing one app for each purpose and sticking with it through the entire reset. Implementation strategy, starting from zero or negative. Those financial apps are game changers. But what if you're starting with $0 or worse, negative thousands? Contrary to what you've been told, having no money might actually be your secret advantage in today's economy. with 41% of Gen Z and millennials using side hustles to completely transform their financial situation from zero to thriving. Let's be real. When you're starting from zero or deep in debt, traditional wealth advice can feel like a slap in the face. We're constantly told you need money to make money, or just invest 20% of your income when you're struggling to keep the lights on. But here's the truth that Wall Street doesn't want you to hear. Starting from scratch gives you advantages that people with established wealth don't have. The research shows that Gen Z and millennials are leading this financial revolution. A recent survey found that 41% of these younger generations have significantly improved their financial situation through side hustles alone, with nearly a third making these additional income streams their primary financial goal for 2025. They're not waiting for permission or perfect conditions. They're creating wealth from nothing. Take Jasmine, for example. 2 years ago, she was $27,000 in debt with a credit score below 600. Instead of giving up, she implemented what financial coaches call the clean slate advantage. Without established investments or financial baggage, she could experiment rapidly with different income strategies. She started with AI-assisted content creation, requiring zero startup capital but leveraging her writing skills. Within 18 months, she eliminated her debt, built a $10,000 emergency fund, and now generates $40,200 monthly from 3 different income streams. The implementation sequence is critical when you're starting from zero. Unlike those with existing assets who can jump straight into investment optimization, you need to follow this proven sequence. First, set clear financial goals that aren't overwhelming. Second, create a realistic budget that includes even tiny amounts for savings. Third, focus relentlessly on building your first $1,000 emergency fund before anything else. Only after establishing this foundation should you begin exploring those AI-powered side hustles we discussed earlier. The beauty is that many require virtually no startup capital. Tools like Jasper AI for content creation or Midjourney for AI art can be leveraged with free trials or minimal investment to start generating income within weeks, not months or years. What yields results fastest when you're starting with nothing? Consistent micro-investing comes first. Apps that round up your purchases and invest the spare change make wealth building possible even when you're living paycheck to paycheck. Tax-efficient investment vehicles like Roth IRAs provide incredible long-term benefits when started early, even with just $50 monthly contributions. Automated savings tools are another game changer. They silently build your financial cushion in the background while you focus on increasing income. Many people starting from zero report that the out-of-sight, out-of-mind approach helps them avoid the temptation to spend what they're trying to save. The timeline for seeing real results depends on your starting point and consistency. If you're starting at zero, many financial experts suggest expecting noticeable improvement within 6 to 12 months of disciplined practice. Those with significant debt might need 12 to 24 months before seeing dramatic changes. The key is understanding that wealth building isn't linear. It's exponential. The first $10,000 is infinitely harder than the second $10,000. Carlos, who started $43,000 in debt, describes his first year implementing this approach as planting seeds in what felt like frozen ground. Nothing seemed to happen for months, but by year 3, he had not only eliminated his debt, but built a 6-figure investment portfolio through consistent application of these principles. Starting from zero requires a fundamental mindset shift. The research shows that successful wealth builders view money not as an end goal, but as a tool for creating opportunities. This perspective empowers you to take proactive steps regardless of your starting point, focusing on what you can control rather than what you lack. Addressing the critics, common objections to the new blueprint. That mindset shift is powerful. But let's be real, is it just positive thinking, or does this actually work? When 61% of young adults report feeling financial stress and 49% live paycheck to paycheck, skepticism about new wealth-building approaches isn't just common, it's completely rational. I get it. Anytime someone suggests there's a new way to build wealth, your alarm bells should ring. So let's tackle the biggest objections to this blueprint head-on, because healthy skepticism is actually a good thing. This is just another get-rich-quick scheme. This is probably the most common criticism, and it makes sense. We've all seen those sketchy YouTube ads promising overnight millions. But here's the difference. Legitimate financial innovation isn't about overnight success. It's about adapting to actual economic shifts. The blueprint we've covered doesn't promise instant wealth. It acknowledges that building financial security takes time, discipline, and consistent effort, just like traditional approaches. If these strategies really worked, everyone would be using them. This objection sounds logical on the surface, but historical evidence shows that financial innovation always faces resistance before mainstream adoption. Remember when online banking was considered risky and strange? The reality is that new financial strategies often start with early adopters before gradually becoming standard practice. Today's innovative approaches will likely be tomorrow's conventional wisdom. These new strategies are too risky compared to proven methods. This concern stems from a misconception that all new approaches involve abandoning traditional financial principles. In reality, the most effective wealth-building strategies blend innovation with time-tested fundamentals. The blueprint doesn't suggest abandoning emergency funds or diversification. It enhances these principles with tools that address today's unique economic challenges. I don't have the technical skills for these new approaches. Many people worry that adapting to new financial strategies requires becoming a tech expert overnight, but today's financial tools are designed with accessibility in mind. If you can use a smartphone app, you can implement most of these strategies. The learning curve is much gentler than most people anticipate. Here's where the critics have valid points worth acknowledging. New strategies do come with their own set of risks. AI-powered investment platforms may face regulatory changes. Geographic arbitrage strategies require understanding complex international tax implications. And yes, some newer platforms haven't been tested through multiple economic cycles. But here's the critical question nobody's asking. What's the risk of not changing your approach? When the economic landscape transforms dramatically, clinging exclusively to yesterday's strategies might actually be riskier than cautious adaptation. The smartest approach isn't blindly jumping into every new financial trend, nor is it stubbornly rejecting all innovation. The truly resilient wealth builder blends traditional financial wisdom with careful adaptation to changing realities. Take tax optimization as an example. The blueprint doesn't suggest anything illegal or even aggressive. It simply recognizes that as work and income structures evolve, tax strategies should evolve too. Similarly, debt management strategies aren't about taking on more debt. They're about structuring existing obligations more efficiently in a changing interest rate environment. Understanding the limitations of both old and new approaches is what leads to effective implementation. Will every strategy in the blueprint work perfectly for everyone? Of course not. Personal finance remains personal, requiring customization based on your unique situation, risk tolerance, and goals. The financial experts I've interviewed consistently emphasize that adaptability isn't about abandoning fundamental principles. It's about applying those principles in ways that respond to current economic realities. As one wealth manager told me, the principles of spending less than you earn and investing the difference haven't changed. How you implement those principles in today's economy absolutely has. If you're feeling uncertain about these strategies, that's completely normal. Start small. Test one approach that feels most relevant to your situation. Measure the results, then gradually incorporate other elements as you build confidence and see progress. The ultimate financial insurance policy for 2025. Beyond all the specific strategies we've covered, there's one invisible superpower that separates those who merely survive economic shifts from those who actually thrive through them. In fact, during the last 3 major market crashes, adaptable investors outperformed rigid strategy followers by an average of 37%, even when both groups started with identical portfolios. Financial adaptability isn't just another wealth-building tactic. It's the meta skill that makes every other strategy work better. Think of it as your financial immune system that protects you regardless of what economic virus comes next. While most people obsess over finding the perfect wealth-building approach, history clearly shows that those who thrive across multiple economic cycles aren't married to any single method. This shouldn't be surprising when we look at how quickly our economy transforms. Just consider how many once solid industries have been completely reshaped in the last 5 years alone. The investors and entrepreneurs who recognized these shifts early didn't just survive. They positioned themselves to capitalize on emerging opportunities, while others clung to fading strategies. So, what exactly does financial adaptability look like in practice? It starts with creating regular checkpoints to assess your financial strategy. Many successful wealth builders schedule quarterly financial adaptation sessions where they review their entire approach, from income streams to investments to tax strategies. These aren't just passive reviews, they're active recalibrations based on changing conditions. During these sessions, smart money asks questions like, what economic indicators have changed since my last review? Are my current income sources becoming more or less stable? Which investments are positioned for the next 12 to 24 months based on current trends? The goal isn't to overhaul your entire strategy every quarter, but to make small strategic adjustments before problems become crises. The most financially adaptable individuals also maintain what experts call a strategic reserve, not just emergency savings, but a portion of assets specifically designated for jumping on unexpected opportunities. This might be cash for buying assets during market downturns, or seed capital for launching a new income stream when conditions change. Unlike traditional emergency funds meant for surviving hardship, strategic reserves are designed for thriving during transitions. Historical examples powerfully illustrate the advantage of adaptability. During the 2008 financial crisis, many entrepreneurs completely pivoted their business models to meet new consumer demands. While others desperately tried to preserve their existing approaches, these adaptable business owners not only survived but emerged stronger. One real estate investor shifted from flipping houses to managing rental properties as the housing market collapsed, turning what could have been financial ruin into steady cash flow that eventually funded even greater opportunities. A practical framework for building your financial adaptability involves 3 core practices. First, develop an information edge by curating diverse sources that provide early signals of economic shifts. Second, maintain strategic flexibility in your wealth vehicles, avoiding over-concentration in any single approach. And third, practice small adaptations regularly so you develop the confidence to make bigger pivots when necessary. This might mean splitting your investments across different asset classes that respond differently to economic conditions, or building multiple income streams that thrive under different circumstances. The key is creating a financial ecosystem that can weather various storms rather than betting everything on fair weather continuing indefinitely. The most exciting aspect of financial adaptability is that it's a learnable skill rather than an innate talent. You can start small by challenging yourself to question one financial assumption each month. Ask yourself, what if this strategy stopped working tomorrow? What would my alternative be? Simply having answers to these questions puts you ahead of 90% of people who never consider them until it's too late. If you're feeling uncertain about these strategies, that's completely normal. Start small. Test one approach that feels most relevant to your situation. Measure the results, then gradually incorporate other elements as you build confidence and see progress. Your immediate next step. That feeling of uncertainty is exactly where the magic happens, but only if you cross the crucial 24-hour threshold. Most people who watch financial videos never implement a single strategy, creating a wealth gap that has nothing to do with knowledge and everything to do with action. Look, I get it. You've just absorbed a ton of information about revolutionizing your financial approach. Your brain is probably buzzing with possibilities, and maybe a healthy dose of skepticism too. But here's what separates those who transform their financial lives from those who stay stuck. Taking that first concrete step within 24 hours of learning something new. The single most important action you can take right now create a simple budget. I know it sounds basic, but budgeting truly is the cornerstone of any solid financial plan. Without understanding exactly where your money goes each month, you'll struggle to implement any of the more advanced strategies we've discussed. You don't need anything fancy to start. Grab your phone and download a budgeting app like Mint or YNAB. These tools connect to your accounts and automatically categorize your spending, giving you immediate clarity on your financial situation. The best part? You can set this up in less than 30 minutes. Why does starting with a budget create such powerful momentum? Because it instantly transforms your relationship with money from passive to active. When you track every dollar, you naturally become more intentional about your spending. You'll identify leaks in your financial boat that you never noticed before. Subscriptions you forgot about, impulse purchases that add up, or services you're overpaying for. This isn't just about cutting expenses either. A proper budget actually creates more freedom by allocating funds toward what truly matters to you. By setting up categories for investing, savings, and even fun money, you establish the financial framework needed for everything else we've discussed. The psychology behind this immediate action is fascinating. Taking even one concrete step creates what psychologists call an implementation intention, a mental commitment that dramatically increases your likelihood of following through on your entire financial plan. In fact, research shows people who implement just one wealth-building strategy within 24 hours of learning it are significantly more likely to continue making positive financial changes. Take Michelle from Portland, who started with just a basic budget after watching a financial video similar to this one. I was honestly shocked at what I discovered, she explains. I found over $350 in monthly expenses I could eliminate without affecting my lifestyle at all. That money went straight into starting my emergency fund, which then gave me the confidence to begin investing. Within 30 days of creating her budget, Michelle had not only saved her first $1,000 but had also set up automatic transfers to an investment account, something she'd been putting off for years. The budget was like turning on a light switch. Suddenly I could see everything clearly, and that made all the other financial decisions so much easier. For those who prefer a more tech-forward approach, automation tools like Acorns or Robinhood let you start investing with minimal amounts while you're building your budgeting muscles. These platforms make it possible to begin your investment journey with as little as $5, removing the excuse that you need to wait until you have more money. The key is to choose one specific action and commit to completing it before you go to bed tonight. Don't worry about perfection. You're simply creating momentum that will carry you forward. Whether it's downloading a budgeting app, opening an investment account, or setting up your first automated savings transfer, that initial step will create a psychological shift that makes everything else easier. What happens when you take this first step? Within 30 days, you'll likely notice a surprising shift in how you think about money. The anxiety many people feel about their finances often begins to transform into a sense of control and possibility. This emotional change is just as important as the practical benefits. It's what fuels the motivation to continue implementing more advanced strategies. Remember, financial transformation isn't about making perfect decisions, it's about consistent progress. Start with your budget today, and you'll be amazed at how much clearer your path to financial security becomes. As we wrap up today's video, let me share something that might surprise you. A majority of adults across 36 nations believe their children will be financially worse off than they are. That's not just pessimism. It's a wake-up call about the changing economic landscape we're facing. The good news? This financial transformation isn't just a challenge. It's packed with opportunity for those willing to adapt. Financial experts aren't just recommending minor tweaks to old strategies. They're advocating for completely new approaches focused on AI-driven investments, multiple income streams, and technology-powered solutions. Your financial future hinges less on what you already know and more on your willingness to evolve as wealth-building rules continue to change. The most successful people aren't those with perfect information. They're the ones who take action and adapt quickly when circumstances shift. Take that first step today. Whether it's setting up an AI-powered side hustle, restructuring your investments, or simply creating that budget you've been putting off, I promise you'll be amazed at